We try to start it, all right, it's a little over 8:30, so I'd like to call the Audit and Finance Committee to order. Welcome to our guests, and I'm assuming that everyone looked over the minutes in the report, so I would like to
I move we accept the minutes.
Can I get a second?
The consent agenda, right?
The consent agenda, yep.
I think I'll second that.
Has anyone needing any, no, okay, all in favor?
Aye.
All right. Next up, the treasurer's report, Mike.
I'm going to move the treasurer's report,
To the
Madam
end.
Chair, if I can, to the end, so we can hear from our auditor.
Absolutely. All
And
right. Okay.
Nicole Overbaugh from UHY, and going to make the presentation.
Yeah, thanks everyone. So today we have the audited financial statements in a draft form for the year ended December 31st, 2023. I mean, overall, I think the audit went pretty well this year. I would say it was one of the more straightforward, smoothest years we've had in recent history. And I think when we go through things, you'll see it was pretty straightforward and we didn't really have any findings or issues. We didn't have any new accounting standards that we had to adopt this year, so that also helped. I mean, last year you had the lease standard that we had to implement. And you'll see when we get to the yellow book letter in the back, we didn't have any material weaknesses or significant deficiencies, no findings that we had to report. So overall, a good audit year. So just going to page 1, our audit opinion. It's an unmodified, clean opinion, which is what you would expect. So really the language in the first 3 pages are just standard language. Go to page 8 next. So this is your statement of net position. And to point out some of the highlights. So when you look at your total assets year to year, you'll see your total assets increase from the prior year. From 4.4 million to 4.8 million, a $348,000 increase. And then on the other side, on the liability side, your liabilities also increased pretty much the same amount. They went from 1.3 million to 1.7 million, an increase of about 324,000. So really the main changes this year is really just continuing to invest in your loan fund. So you had additional loans that you entered into, which increased your assets, and what funded that was additional borrowing from the SBA. So on the liability side, you also had additional borrowings from the SBA that increased your loan fund. You also had some CDBG money, so that's on the liability side, it's in your unearned revenue, so the 474,696 under 9 current liabilities. So you get the CDBG money that you then go and enter into a loan with a company. So your loan receivable balance increases and then the unearned revenue increases. And the reason it works that way is you haven't earned that money until the entity demonstrates that they've, fulfilled the FTEs and everything that they promised you. And then when they do that, then you recognize the revenue related to that CDBG money, and then you recognize a grant to the person that you lended the money to. So that loan converts into a grant based on the terms of the agreement at a certain period of time once they've demonstrated that they've done what they need to. And then your cash, it did decrease from 1.4 million to about 733,000. But you can see you invested in a certificate of deposit. $410,000 was moved to a CD. And then again, just continuing to invest in that loan fund decreased the cash. So then on page 9, your statement of revenue, expenses, and changes in that position. You had budgeted for, a 0 net income, and your ultimate change in net position was $16,004. So pretty much right on budget. Under operating revenue, you can see the administrative fees from the related party. You amended your contract with the IDA from $24,000 for the year to $12,500. So you can see that decrease there. But ultimately, you were able to recognize additional admin fees from the Hudson IDA, 17,500 more than last year. So that really offset the decrease in the admin fees from the IDA.
In addition, you'll remember we took $25,000 and added it to loan loss reserve. So had we not done that, the net would have been almost $40,000.
Yep. And then also just your, comparing year to year to some of the more significant changes, your personnel and benefits increase, and that's really, a result of adding more staffing, also some pay rate increases. And then your grants, you can see there's a significant decrease there year over year. So you went from 286,000 to 80,000. But if you remember last year, we had that Flanders grant that got recognized as a grant. So that's kind of like that CDBG money that I was talking about earlier, where it was sitting on the books as a loan and a liability, and then they met the FTE requirements and you forgave it. So you had a $200,000 grant last year that you didn't have this year.
And on the increase in employee expense, was primarily funded with the future Columbia Forward grant and the Columbia Housing grant. And those run for another year and a half. And so, we are looking as to how we're going to increase the revenue when those grants expire. I know one way we can do it, but hit my salary. Someday I'll have to retire.
Any questions on those couple pages
ultimate
before
question.
I just go through the footnotes quickly? Brian, if there's any- So then the footnotes,
Could I just ask one quick question?
Yeah.
Just because when we see internals, it's presented a little differently. You have the Columbia County appropriation below the line
yeah,
as a part of non-operating. Is that consistent with how it has been in the audited financials?
Yeah.
And could you just give a sentence on the rationale there? Because I realize it's not a multi-year agreement with the county, but it is kind of a significant, consistent, recurring revenue stream that supports the overall
yeah,
expense profile for the organization.
be honest, I don't know why we should.
I think it was because they consider us an entity of the county. And so they don't see it as income, they see it as a transfer.
Okay.
That's the way it was explained to me. And as you point out, it's been the $460,000 for 10 years. And if they provide other grants, because I've always asked that.
But not a multi-year contract with the county for appropriations,
Yeah.
right? It's a year-to-year
Year-to-year,
appropriation.
yeah. And, because the first time, if you go back to page 6, it made a little more sense the way it's presented there, because it shows, operating revenue. And then it shows the appropriation from the county. I look at it differently. I look at as a fee for service contract to the county to provide services that they would otherwise have to provide themselves. But I know early on, I finally accept some of the things that they tell me we have to do rather than question them.
Well, ultimately, these financial statements get consolidated with the county too, so.
Yeah.
I mean, they must treat it as an appropriation on their end, and so I think it's.
They see us as a county department. I mean, I get an email as a county department head. When they send those out, they have me on that list. And I have to submit the budget in the same cycle as the other county departments on an annual basis for the county to include it in their budget.
And from your perspective, no need to disclose anything about the annual appropriation of about just under half of our annual, third of our annual budget.
So there is a related party disclosure that discloses on page 15.
Yeah, and this is Brian Kearns, so he's a partner in our Albany office, and he's been working with me on the audit as well. Yes, I was in the 15.
I mean, that's pretty light compared to the nature of the materiality around it.
And don't you have
We
a,
have a related party
Yeah.
footnote too, on page 22. We actually don't talk about it there, I think because we have it on page 15.
Yeah, I'm not opposed to having the type, make it more prominent. That's why I keep, I've always tried to keep $500,000 in working capital so that if we did get, if we get, my sense is if it was cut, we wouldn't be cut 100%. But, we would give us a year to figure out how we would restructure the organization if they weren't willing to restore it.
I'm less on the disclosure. I think I'm just a little bit more on the below the line presentation and understanding.
Okay.
That's all.
And I did want to point out on page 17, also in concentration, so talking about the
Yes.
materiality of it.
Yes.
The final sentence under the concentration footnotes, it does state the corporation received $710,000 from Columbia County, which includes that appropriation. So talking about representing 60% of the total revenue of the organization, saying, hey, it's coming directly from Columbia County, the majority line share of your operating and appropriation, all revenue is, just to disclose that it is substantial.
And it's not insignificant because 10 years ago, the county did, for a short period of time, restrict funding the appropriation. And during COVID, they reduced us by 10%, which is why we took out the $100,000 EID loan, which is now at about 80.
Mike, if we're considered an entity of Columbia County, how many, are they required supervisors part of our CEDC?
Well, we have the bylaws provide that the chair of the board of supervisors or his or her representative is an ex officio board member. And my
Just one or?
just one. And
Is that Scalera?
yes, and he's going to roll off, I believe. But the other side of it is our contract with the county requires me to attend the Economic Development Committee meetings and all Board of Supervisors meetings, and I have to provide a written report to them.
Really? You get benefits?
No, but it's great because where can you see 18 people who have day jobs in one location when you need to, get a quick approval from them or give them some information? I mean, it's,
Yeah.
they put me, they want to put me in the front of the class because I kind of try to network while they're having the meeting and they don't like that.
You're good?
But the teacher always put me in the front of the class anyway.
Yeah, so then just in the footnotes, page 12, I just wanted to point out, there's where it really talks about that CDBG loan program. The two new loans that were added is the Return Brewery and Kleinskill Fruit Farm this year. So that explains, how that works.
In the past, going back 5 or 6 years, we would only book the asset, right?
Well,
And not the
it's
life.
always depended on the agreement. I
Yeah.
think there's been different iterations of the way the agreement has been written in the past. So then the accounting has,
Because the issue there then is you're, at the end of the grant, you gotta write off the whole grant because you turned it into, you turned the loan into a grant.
Right.
And that really,
right, so that's what happened last year
Yeah.
with Flanders, where the revenue had been recognized in the prior year, and then we had the expense last year. I mean, all these footnotes are pretty much just the same as last year and rolled forward. Page 17, I just wanted to point out the FDIC exposure there. So you do have about $900,000 of cash that is in excess of your FDIC coverage. I know, that has been
we
the
go,
case and we talk about it every year.
and there's supposedly some type of program for not-for-profits where they can collateralize it, but I've had no luck trying to get, if you Google it, you can find that banks are supposed to be able to do that, but either they don't know it or they don't want to do it.
There's no recommendation of a reserve or anything. It's just a disclosure.
No, it's just the fact that,
You know,
it's a concentration, you're in excess of the coverage and, you should access,
I think
the
that,
banks that you have the cash in and make sure, you feel they're strong and you don't have any concerns, but.
and obviously, when we look at the report of banks, the reason, if you look at Community Bank, Bank of Greene County, we're under, and it's at Key Bank where we're over. And so, from an administrative standpoint, running the loan program through Key Bank where There's online ability to do the transfers as opposed to, calling up. And there's, we have the scanner and we have, the capacity to do some of the issuing the loans and collecting the payments is easier with one bank. Otherwise, you're gonna have 3 scanners on your desk and, because they all have a different platform. But, it is something that they point out regularly and that we're conscious of. And obviously, no bank is too big to fail, as we've seen.
Yeah.
But we still have the, so it is something we're watching, and perhaps at a committee meeting, we could have a discussion as to what the committee would like us to do with respect to that. That to me is the only thing that pops up that is an item.
Yeah, even, are you gonna, I was about to say that.
Yeah, I was just gonna say, yeah, you also have a, fairly significant CD maturing next month. And so it's nice to be able to get interest revenue with interest rates being as high as they are too. So to make sure you take that into consideration as you, renew and budget, in
But even
terms
that CD, like you put it in one CD, it's 400,000, like you could have put it into multiple CDs and.
And I think the issue with the CD was, and we had this discussion at the loan committee, and we're going to present it to the full board. But by putting the CD was comprised of county loan funds. And what it did, it put intense pressure on us to actually feel that we had almost run out of county loan funds, because we were putting money on the street faster than it was coming back in. And so by having that CD out there, it made us realize that we have to have a plan and a report and a model to determine, with a 5% or 10% default rate, which we've never had, how much can you loan on an annual basis without putting yourself out of business? Because the money's not coming back on a 5 to 7 year schedule fast enough to replenish it. So not only did we pick up $20,000 in interest, or 10,000 because it was a 6-month CD, or maybe it was a year. We learned that we are going to have to set some loan goals and monitor the return of cash to relend. But it was a good. It worked in 2 ways. It taught us something that we knew, but and it doesn't tell you. Because right now, we have about 150,000 we could lend at a free, and we have to remember that the day that the CD comes due, we can't put 300 of it on the street.
Yeah, and just a note on that, that's kind of disclosed on page 18 about the loan activity. You have, over 1.3 million of new loans dispersed during the current year, which is great, from.
Well, but you gotta remember, for a long time, we only had 50% on the street.
Okay.
And so our goal was to get to $100,000 in annual interest, and I think we made 85 this year. Between the two.
Yeah,
85. So we consistently moved up, and we did report to the loan committee yesterday that, over the past 9 years, because we've left all the interest on both the SBA loans and the CEDC loans in the loan fund, not using any for operations. We've added about $650,000 in interest to the enterprise.
Any other questions on the audit? Right, can I get a motion to approve the audit?
So moved.
All in favor?
Yeah.
Are you in favor?
Hi.
All right, so next up,
Just
you want to
real
go
quick,
to the related, go ahead.
Oh, I was just gonna say, just real quick, transition to the single audit. So you are required to have a audit compliance with uniform guidance, and federal standards. So, that's your separate report here that you have in front of you. And really, if you could just go to page 8, kind of summarizes it all. From an audit standpoint, it's really good news this year. Be proud of the entity in terms of, because with regards to a single audit, it's not only compliance audit in terms of all federal standards related to these loan programs and all federal expenses, but it's an audit of controls over compliance, and so as you can see the summary, that over the financial statements, you have an unmodified opinion. Highest level of assurance you can receive from that independent CPA that your financials are free of material misstatement. They're in accordance with all generally accepted accounting principles. So that's great news. You have no material weakness identified over financial reporting. You have no significant deficiencies, no compliance matters noted. And then when it comes to the federal awards, there was no material weakness or significant deficiencies this year. And we are required to report on a status update of prior year findings. So on page 9, you can see that last year there was a significant deficiency over financial reporting. And this year, the entity has, addressed that. They've enhanced their controls, and you've addressed that, and no such matters had come to our attention in the current year. Where, so again, a very good, clean report that you should be proud of in terms of this. And this gets uploaded to the federal data clearinghouse, so it's publicly available, and so that's really a summary of the single audit.
Congratulations.
You guys probably know we're looking for another bookkeeper, right? We haven't
So
found.
we've, because of the fact that the single audit kicked in, it's not possible for you to continue to give us day-to-day accounting guidance. And so we had contracted with a firm in Rhinebeck, Zulch, and they actually fired me because they said they were only going to do this kind of work for people who they did their tax returns and their audits. And, they're getting, $300 or $500 a month. So it wasn't worth it to them.
Yeah.
And they needed to focus on their client base. So we have, in preparation of these reports, we did retain RBT. And we have a discussion at our next committee meeting as to whether we want to enter into a agreement for them to close the books quarterly with us, or whether we want to pay as we go. And so,
But you got good support from them during the audit, understanding there was.
Yeah, we didn't work directly with them. It was more Mike orchestrating closing the books with them, but it definitely helped. When you look at, we didn't really go through the required communication letter, but in the required communication letter, we list, any adjustments that we had in, prior years, we've had a bunch of adjustments.
Yep.
This year, we don't have any material adjustments that we proposed during the audit, and that's because, Mike took the initiative to get that extra help. And
but I also think that if you, what I always do is make a list. I sit with Kat, our bookkeeper, and we make a list of where we think we have questions. And it was such an extensive list that Nicole.
because Mike always will call me and go through that list, and I'm happy to go through that list and tell him what needs to, happen.
But I gotta go do it myself.
Right, but the problem is just then the actual
Booking of entries.
booking of entries,
My
there
point
was
was
a gap
that
there.
the extent of the list, that if we hadn't gone out and gotten support, you would have a lot of things in here.
Right, and so just to step back real brief on that, the context of it is, if we're performing too many functions where it appears that we're taking the role of management, right? Worst case scenario, we actually would impair our independence and we wouldn't be able to issue an audit opinion. That's if we're doing too many management functions where we believe that management couldn't even perform the function of overseeing our work. That would be the worst case scenario. That hasn't happened here. The next would be, as Michael and Nicole were just explaining, is that we're performing too many proposed adjustments where you can use us with that function. We can give recommendations, we can give advice, we can catch material errors and fix them, and then management can oversee that. But then we're saying, hey, in regular operations, you should have that in-house to have those controls in place to oversee it yourselves. Otherwise, it's a material weakness or significant deficiency. The definitions of those, they sound a lot worse than they actually are. The significant deficiency is really just a control matter that warrants the attention of those charged with governance in this room that requires or should be considered for improvement. So we could repeat that year over year, but it's great that you were able to, even though you have outside bookkeeping, outside consultants, they can perform management functions independent of us, and then that's part of the management function, so you don't have to.
And I think that, when we look at what those issues were, for instance, when we entered into a contract with the county to provide fiscal sponsorship services for their climate fair, we now need to set up an account, not only on our books to take in funds that people donate for that purpose and pay expenses that the county authorizes us to spend, but we set up a separate bank account. And sometimes it's not clear for Kat or I where we stick that in the chart of accounts. And so that was one of the issues last year. And the other is with the deferral of income, because the county paid us under these grants before the project started, and we didn't want to absorb that income because we didn't start the program until July of the next year. We deferred income. And each time you go and back and forth between deferred income and recording income, and when we do accounts receivable, sometimes the double entry bookkeeping issues jump up, which are
It's really just the unusual transactions that, become, difficult to just manage in-house without having the right
And
resources.
Kat and I know that we need to do something, but if we're not sure, we want to make sure we do it right. So now we have the potential of talking with RBT, and we'll get the committee to decide whether they want us to do that on a fixed fee basis or pay as you go. I like pay as you go, but
So just to maybe summarize, based on the prior finding, which I think is relevant because there was a lot of discussion around that last year. So the prior finding was there were a significant number of entries to be made as part of the audit process as recommended by the auditors during the audit. We've gotten a bookkeeper, we've had a much tighter close for the year 2023, and you guys feel comfortable that the prior finding has been addressed with management creating the majority of the entries and no material misstatements for sure, but even a smaller number of correcting entries to be made as well.
Yep.
So no current finding around that, and then it sounds like as a finance committee, we'll have a conversation about bookkeeping services going forward, because the bookkeeper we used no longer works with us, and we found another bookkeeper to work with.
But the work that was done from the date that I put the list together to review with UHY to the closeout of the field work was done by RBT.
Great.
Yeah, so that worked for 2023. It's just now going forward,
Yep.
how are you gonna
It'll be a
approach that?
discussion with the committee.
And it was, when we realized that we were in that situation, to find a firm of that size to do this for us, only because of relationships. And, they had acquired the Sigler accounting firm here in Hudson, and they jumped right on it, and they put a partner on it, and QuickBooks expert, and they cleaned it up really pretty quickly. And they will be making the adjusting journal entries for us. And then they will be, my thought was to bring to the committee that, if we have them close our books quarterly, I think it's sufficient. Because, and if we do have a question on something in the other 2 months of the quarter, we can make a quick call to them.
Yeah, we can still answer questions throughout the year. It's not, we're not saying that by any means. It's just, having that extra layer.
And my only intention is prior finding, no longer current finding.
Yeah.
Minutes.
Plans in place going forward, because what we did work, except now we're just with a different firm.
Okay, any other audit related correspondence? Any other questions on that? Okay, can I have a motion to approve that?
So moved.
Have a second?
Second.
All in favor?
Aye.
All right.
I did put together a report on legal paper here that I don't know what it really means, but it was fascinating. And basically, our balance sheet, in 2000, 14, we had total assets of 3.4 million, and now we have 4.8. It's basically because of the loan program. And that becomes very obvious when you go down and look at the net position at the end of the year. On 10 years of data, the average net position is 2.738. And, you know, the last 4 years, we've been exactly on average, 2.717, 752, 734, 750, which means that, from what I can tell, the loan program is the restricted revenue and or asset, and that we basically managed to net zero. And if you look up above that line where it says total revenue in excess of expenditures, over 10 years, it's $12,000. And you know, you can see with the exception of 2018 and 2020, and we're going to go back and take a look at what those anomalies were. You know, we have basically managed budget.
Right.
If you'd like the treasurer's
Yeah,
report.
sure. So are we gonna, thanks for reporting all of the,
Brian, thank you.
I appreciate
I want
Nice
to thank
meeting everyone.
and
both.
Brian and Nicole, thank you for providing a lot of clarity.
I want to thank Brian and Nicole, particularly Nicole, who oversees the field staff. They have a great young accountant by the name of Kenny Spurl. And, you know, I told everyone from Howard Foote to Brian to Nicole, don't let him go.
We don't want to let him go. We love him.
And he, I mean, he's you know, he challenges me, but he gets the work done and he does it professionally and knowledgeable. And I also want to thank Kat Leiden, our bookkeeper, who not only does this on a daily basis, and you know, when we look at you know, the 10,000 transactions that go into you know, booking 150 loan checks 12 times a year each, and the number of transactions we do. I want to thank Kat for all of her efforts as well.
Thanks, Kat.
Thank you very
All
much.
right.
So,
And thank Matt Vanderbeck, who you know, at one point was our overseer, but because of the need to rotate partners, unfortunately, kept Brian.
Appreciate it. Nice meeting everyone.
Very nice meeting, thank you.
so I guess we'll go to the treasurer's report now.
We look at the balance sheet, which is the third sheet in. And we look 2/3 of the way down to the total bank accounts. We have 1,849,000 versus 2,009,000 last year. It's 160,000. And you know, it's basically because we took funds and purchased the property that the county asked us to purchase out on Route 9H. You know, our other current assets are up because we have the Kleinkill housing loan, which we booked, which was not on our books in 2023 in February. And on our accounts receivable, our total accounts receivable on the next page. This is not a total. But basically, our accounts receivable are the SBA, if you go to the bottom of the first page. Our technical assistance is up 13,000 from last year, but that's because we had gotten a significant increase from the SBA. year over year. Our Columbia County is the monthly $460,000 for the month that hasn't been collected. We do have $15,000 receivable from the county on broadband. We have money that the county owes us for last year on Columbia Forward, the 7.5. And they sent a letter to the county who responded that they owe that. So there's no question there.
They being the auditors.
Yeah.
Okay.
And then, the others are just the next month's payment. When we get down to our loans receivable, you can see on the county loan fund side, it says CEDC loan funds total. We're at $1,311,000, which is $321,000 more than last year. And you can see on the SBA loans receivable that we're up 291. So we basically did $600,000. We have $600,000 more on our books in loans this year than we had last year. And as I said, we were at 50-50, where we had 50% available to lend and 50% on the street. So this has been really a tremendous year, and Martha and Steve have done a great job of getting the money out and then putting a plan together to manage it going forward. We were very pleased to report that in the second quarter of the federal year, which was the fourth quarter of the calendar year, we had 11 SBA loans for over, I believe, $300,000. And we were the highest micro lender in the state, including competing with Pursuit, which does micro loans statewide. And our hope is that will drive not only the technical assistance grant level, but also drive additional tranches of funds. When we look at the total balance sheet, total assets at the bottom, you'll see we're at 5.1 million, and at year end, we were at 4.8. That's because we took down another $275,000 of SBA. On the liability side, the biggest number is deferred revenue. Deferred revenue includes the 4 grants that the state passes through us so that we don't take the hit when the loans get converted to grants. And it includes the deferred funding from Columbia Forward, the housing funds, and the Columbia Forward grant program. And that's where we started those programs mid-year in 2023, and they paid us for the whole year. And I didn't want someone to say you took the money and spent it on something else, but I also wanted it so we could carry the program out an extra 6 months at the end. Any questions on the balance sheet?
Does the county have to go through CEDC to purchase property?
No, it would otherwise have to go through the same process. But part of it is you want to purchase property in a time frame that doesn't necessarily match your budget. So they don't have the budgeted funds in a line item to purchase property. And in the case where we purchased the property, we had sold property for them, and they asked us to hold those funds for their future economic development purposes, and we used those funds to purchase the property. And that was the 9H property. On the income and expenses, since we are running late, we're $18,000 above budget for income. And we are on the expense side. We have $165,000 in expenses versus 219. So I guess actually the income is down 18,000 and the expenses are down 54,000. So we're at a net of 50,000 versus 22. So we're $72,000 better than budget. We are down on employee expense because we haven't replaced Jessica at this point. And we are down on new initiatives, $27,000 because those programs aren't necessarily 1/12 expensed. They are larger amounts as the year goes on. So I think one of the things I am pleased about is we finally have gotten to where our office expense, we're at 21,000 versus 22,000 budgeted. And as you'll recall, in the past, we were in a situation where that was totally out of whack in terms of where the budget was and where those expenses were. It is somewhat front loaded, so you don't, it's not gonna be $10,000 a month. Because we pay dues to multiple organizations in January of the year, and as opposed to throughout the year. If you go back 2 pages to the landscape report, which shows profit and loss, and look at the 3rd page of that report. For a long period of time, when you look at the first column, and the headings don't carry over, but the first column is operating, and the other columns are the interest on the loan funds. If you look all the way to the right, you'll see that we had a $49,000 net income, but for operating, almost $20,000 of that net income was net income on the operating line. We've run for many years where that line was a negative, and the income from the loan fund was supporting the operations at a level that made us look like we broke even. So I like to watch that now. And when you looked at that line historically, that's where we eroded cash because we were leaving all the interest in the loan fund, but we were using it to balance the books on paper. And so, now that we are at a point where our operating bank accounts with our CD, not CD, but our reserve account is it's just about 500,000. It's 257 and 217. So we're just short of 500,000, and I try to keep that 460 available on a rolling basis for as working capital reserve, and ensure that at the end of the year we're in a position that if the county did reduce our appropriation, that we would be in a situation where, assuming they didn't do it, if they did it all at once, we'd have a year to figure it out. If they did it over a couple of years, we have more time to figure it out.
And just to the conversation we had with the auditors, I mean, the county money is up in operations, like the way you're recording this, it looks like it's part of core, and they call it something different. So I'd love to explore that with them a little bit more if you can.
Yeah.
Just because it's material difference, right?
Yeah. Well, and one of the things I wanted to talk to the committee about when we have a conversation about the outside firm is, do we match their grouping report in reconstructing the balance sheet so that we're looking at the same format in both instances? Because as there's 2 places on this report where it says total banking, we have total checking and savings, and then we have total SBA and total bank accounts. Well, we need to, this could be better structured in terms of following it.
I mean, I'll just speak for myself. I'm not sure that I would have a preference in any way. You have to have what you need for your purposes to run the business. I can follow.
This is fine.
reports, but as long as you have what you need for clarity within the reports.
What I like to see is, if it's restricted, I like it at the bottom, so I don't think I can spend it. And I do like to see all the loan stuff together, but it doesn't matter because when they upload all of this stuff into their Excel sheets now, it's automated for them. In the old days, it was tedious for them to have to
Go back and forth.
But, it was very smooth this year. And I do think it was because, Kat had gotten them all of the information early. And we were able to, look at the 10 or 12 items that we both had identified as, things that we had questions on for RBT in a timely fashion. And, I'm on a bank board with the managing partner of RBT, so I want to disclose that, number one. But number two, when he called and told the partner at the office they had just acquired to get this done, and got great attention.
Great,
So,
all right.
thank you, RBT.
Any other questions on the treasurer's report? And thank you, Kat.
Yes.
So no questions, can I have a motion to approve the treasurer's report? Can I have a second?
Second.
All in favor?
Aye.
All right, the portfolio report.
Martha, I think we have in here, do we have a loan report in here? Let's see. No.
Yeah, it's on the back side of something. So something.
I didn't see it.
It's right here. So it's just before the audit.
Okay.
Oh, yeah.
Behind.
So, if you look, it's a short page on the backside of the audit. It shows that we have 135 active loans with $3.4 million distributed, dispersed, but currently 2.4 of that is outstanding. And the sum total of delinquencies is $4,600 on 2.4 million.
Great.
That really is basically two clients who have 4 loans.
That's correct.
And they're really only 1 month late, or 2 months, they're $500. So, again, we came through COVID, and we managed, the fact that Martha and Steve take a loan and put half of it in an SBA account and half of it in a CEDC account really lets us manage the process when they have a default or potential for a default. Because if they're late on 3 payments on an SBA loan, we have to pay the SBA back. But what we do is we buy that loan out of the SBA fund with CEDC money, and then do work out with the client so that they end up paying us in full over time. Where if we had put the whole loan in the SBA fund, we would have to default and put them out of business. So it really is a great model. Martha?
Okay. No, okay, any questions on the portfolio? Can I have a motion to accept it?
So moved.
Second. All in favor?
Aye.
Carried. All right, public comment? Is there public comment? Okay, Sarah reached out to Rich Nesbitt to be recommended for this board. I haven't heard from him, but I believe next time we'll talk about that. And I asked Rachel from Smith Hudson to also, and she said, yeah, she said she might want to serve on this board and she will come next time. So once we talk about that, maybe our next meeting, I think our next meeting, they could be on this board if we approve them in the
And the
full,
whole board.
in the full board potentially. So
That's great.
just putting that up there to
Yeah,
you
and
guys.
that's on the agenda for the full board.
Great.
All committee assignments, not just finance and audit.
Yeah, ours was getting small, so Sarah had a
Great.
fear on that. All right. Can I-
Great, well, thank you very much. I think we're in great shape, and we appreciate all
Thanks
your
for your-
oversight and guidance.
For your help. Any other comments from you? All right, then a motion to close the meeting.
I don't think we ever got to the audit meeting in 15 minutes.
All in favor?
Aye. Of course.
All